In theory, there is no difference between theory and practice. In practice, there is. Yogi Berra said that about baseball, but he might as well have been talking about trading, because there's a massive, devastating gap between how your strategy performs in a backtest and how it performs when you're trading it with real money and real emotions. A study from the Journal of Trading analyzed 1,847 retail traders who had profitable backtests. After 6 months of live trading, only 11% were still profitable. Not because their strategy stopped working, because backtesting had given them a dangerous illusion about what trading actually is. Before you guys roast me in the comment section, here's what I'm trying to say. I'm not telling you backtesting is useless. I'm not saying you shouldn't test your strategies. What I'm showing you is that backtesting, when done the way most traders do it, creates a false sense of confidence that leads to catastrophic failure when you go live. Backtesting answers the question, does this strategy have edge? But it completely ignores the question, can I actually execute this strategy? And that second question is the one that determines whether you make money or blow up. Today, I'm going to break down the specific psychological traps that backtesting creates, why your live results will never match your backtest results, and most critically, what you need to test that nobody tells you to test. Because the traders who succeed aren't the ones with the best backtests. They're the ones who understand what backtesting can't tell you. Let me introduce you to two traders. Marcus spent 3 months developing and backtesting a strategy. His results were beautiful. 62% win rate, 2.11 risk-reward ratio, smooth equity curve, maximum drawdown of only 14%. The backtest showed he'd make 47% annually. He went live with real money, completely confident. 6 months later, he's down 18%. His strategy didn't change, the market didn't fundamentally change, but everything fell apart. Then there's Jennifer. She also backtested a strategy. Her results were good, but not spectacular. 54% win rate, 1.6 to 1 risk reward, max drawdown of 22%. But she did something Marcus didn't. She tested herself, not just her strategy. She's up 31% in those same 6 months. What's the difference? Marcus tested whether his strategy works in historical data. Jennifer tested whether she could actually execute the strategy under real psychological pressure. Marcus optimized for backtest performance. Jennifer optimized for psychological sustainability. And in trading, psychological sustainability beats theoretical edge every single time. Let's talk about the first and most seductive trap that backtesting creates: optimization. You've got historical data. You've got variables you can adjust, indicator periods, entry thresholds, exit conditions. You start tweaking. You run the backtest, adjust a parameter, run it again. You keep going until you find the combination that produces the most beautiful equity curve you've ever seen. Congratulations. You've just curve fitted your strategy to historical data, and you've created something that will fail spectacularly when you trade it live. Here's what happens psychologically. Marcus is backtesting a moving average crossover strategy. With a 20-period and 50-period MA, he gets decent results. But then he tries 23 and 47, slightly better. Then 25 and 52, even better. He keeps testing different combinations until he finds that a 27-period and 49-period MA produces the best backtest results for this specific historical period. His brain interprets this as, I've discovered the optimal parameters. He hasn't. He's discovered the parameters that best fit the random noise in this particular data set. It's like looking at a chart and drawing a trend line that touches every single wick perfectly. It looks precise. It's actually useless because it won't predict future price action. It's just describing past price action in excessive detail. There's a concept in statistics called overfitting. When you optimize a model too much to fit past data, it loses the ability to generalize to new data. In machine learning, they deal with this by splitting data into training sets and validation sets. But most retail traders don't do this. They optimize on all their historical data and then are shocked when live trading doesn't match. Jennifer understood this trap. She backtested her strategy with reasonable, round number parameters. She didn't try 50 different combinations searching for the perfect one. She tested whether a simple moving average crossover had any edge at all, not which precise combination produced the prettiest backtest. Her backtest results were less impressive than Marcus's, but her backtest was actually testing a robust principle, not curve fitting to noise. Here's the psychological danger. The more time you spend optimizing a backtest, the more confident you become in the strategy. Marcus spent 3 months on his backtest. By the end, he was absolutely certain he'd found something special. That certainty is dangerous. It makes you dismiss warning signs when you go live. It makes you override your risk management because you're so sure the strategy works. Professional quantitative traders at firms use something called walk-forward analysis. They optimize on one period, test on the next period, optimize on that period, test on the next, continuously. They're not looking for the parameters that worked best in the past. They're looking for parameters that continue to work as time moves forward. Most retail traders don't do this because it's tedious and it produces less impressive-looking backtests. But it's the difference between testing a real edge and creating a beautiful illusion. There's also something insidious about optimization. It gives you a false sense of control. Marcus feels like he's mastered his strategy because he's tested hundreds of parameter combinations. He feels like he understands exactly how it works. But he's optimized away all the uncertainty. Real trading is full of uncertainty. His backtest has removed the psychological experience of uncertainty, so when he goes live and encounters it, he's completely unprepared. Here's the second massive illusion. Backtests assume perfect execution. Every signal is taken. Every entry is at the exact price you want. Every exit happens precisely at your stop or target. No hesitation, no second guessing, no emotional interference. This is so far from reality that it borders on fiction. Marcus's backtest showed 180 trades over 2 years. In his backtest, he took all 180. Every single one. No exceptions. When he went live, here's what actually happened. He saw a signal. It looked good in the backtest, but in real time, he felt uncertain. The market looks a bit choppy today. Maybe I'll wait for the next one. He skipped it. That trade would have been a winner. Next signal comes. This one he takes. It loses. Now he's down money and kicking himself for skipping the winner. Next signal comes. He's hesitant because the last one lost, but he forces himself to take it. It loses too. Now he's down on 2 consecutive trades and he skipped the winner in between. His psychology is deteriorating. Next signal comes. He's afraid now. The last 2 signals lost. Even though his backtest showed that 2 losers in a row is completely normal with a 62% win rate, experiencing it in real time with real money feels different. He skips this one. It's a winner. He's now missed 2 of the 4 winners and taken both losers. This is called signal selection bias, and it destroys the correlation between backtest results and live results. Your backtest assumes you'll take every signal. You won't. You'll take the signals when you feel confident and skip them when you don't. And your feelings have nothing to do with which signals will work. Jennifer addressed this differently. During her backtest development, she didn't just test the strategy, she tested herself. She paper traded the strategy for 2 months, treating every signal as if it were real money. She kept a journal. Signal occurred. Did I want to take it? Why or why not? Did I hesitate? What was I feeling? She discovered something crucial. On signals that appeared in the first hour of the trading day, she felt more confident and took them consistently. On signals that appeared in the last hour, she felt uncertain and often skipped them. When she looked at the data, signals in the last hour actually had a slightly higher win rate. Her psychology was backward. Armed with this information, she created a rule. All signals must be taken or none. No discretion. She knew that her discretion was biased by her psychology in ways that hurt performance. Marcus assumed he'd take every signal because that's what his backtest assumed. Jennifer tested whether she actually would and built rules to force consistency. There's also execution slippage. Your backtest assumes you get filled at the price you want. In reality, you get slippage on entries and exits. You hesitate for 3 seconds and miss your entry by 5 pips. Your stop gets filled at a worse price during fast movement. These aren't huge differences on any individual trade, but across 180 trades, the cumulative effect is massive. Marcus's backtest showed an average loss of 50 pips per losing trade. In live trading, his average loss was 57 pips because of slippage, widened spreads during volatility, and occasional stop-loss movement when he convinced himself the trade needed a bit more room. That 7-pip difference per losing trade, multiplied by 68 losing trades, cost him 476 pips. Jennifer built slippage into her backtest expectations. She assumed every entry would be 2 pips worse than ideal, and every stop would be 3 pips worse than planned. Her backtest results were less impressive, but they were realistic. When she went live, her results actually matched her expectations because her expectations included the friction of real execution. Here's the third and most devastating illusion. Backtests are emotionally sterile. You're clicking through historical data, seeing wins and losses as lines on an equity curve. There's no fear, no greed, no anxiety, no euphoria. You're not experiencing the psychological reality of watching your account balance fluctuate with real money at risk. Marcus's backtest showed a drawdown period where he lost 14% over 6 weeks. In the backtest, this was just data. 6 weeks of negative performance that eventually recovered and led to new equity highs. He looked at it and thought, okay, 14% drawdown is manageable. I can handle that. He couldn't. When that drawdown happened in live trading, it wasn't data. It was his money. Real dollars disappearing. Week 1, down 3%. Uncomfortable, but okay. Week 2, down another 3%, now down 6% total. He's starting to question the strategy. Week 3, down another 2%, now down 8%. He's on trading forums asking if other people's strategies are working. Week 4, down another 3%, now down 11%. He's seriously considering abandoning the strategy. Week 5, down another 2%, now down 13%. At this point, Marcus's psychology is completely destroyed. He's not following his strategy anymore. He's taking smaller positions because he's afraid of more losses. He's skipping signals because he doesn't trust the system. He's checking his account every 20 minutes, unable to focus on anything else. The backtest showed that the strategy recovered from this drawdown and went on to make new highs. Marcus abandoned it at the bottom. The backtest didn't prepare him for the lived psychological experience of a 14% drawdown. The pain, the doubt, the social pressure when people ask how your trading is going, the temptation to change strategies, the fear that this time is different, and the drawdown won't recover. Jennifer did something radical. After her backtest, she identified the worst drawdown period in her data, a 22% loss over 8 weeks. Then she paper traded through that exact scenario, but she tracked her psychological state throughout. She forced herself to feel it. Every week, she looked at her paper account down another few percent. She journaled how she felt. She noticed when she wanted to quit. She identified the exact moment where her confidence collapsed, week 6, when the drawdown hit 18%. Armed with this knowledge, when she went live and eventually hit a drawdown, she knew what to expect psychologically. At week 6, when she felt that familiar collapse of confidence, she recognized it. This is the moment I identified in my practice. This is normal. The backtest showed this recovers. She didn't abandon the strategy because she'd already lived through the psychological experience in paper trading. Here's what's fascinating from a psychology perspective. Your brain doesn't distinguish much between imagined experiences and real experiences if you engage with them deeply enough. Athletes use visualization for exactly this reason. Jennifer's deep engagement with her paper trading drawdown created something like a psychological inoculation. When the real drawdown happened, it wasn't completely foreign. She had a reference point. Marcus thought his backtest had prepared him for trading. It had prepared him for the market conditions. It hadn't prepared him for his own psychological reactions to those market conditions. And in trading, your psychological reactions matter more than the market conditions. Let's talk about something that makes backtests dangerously misleading. You're backtesting in a specific historical period, and that period might not be representative of what you'll face going forward. Marcus backtested from 2021 to 2023. This period included strong trending moves in certain currency pairs. His trend-following strategy looked phenomenal. What he didn't realize is that 2021 to 2023 was an unusually trendy period. When he went live in 2024, market conditions were more range-bound. His trend-following strategy, which crushed it in the backtest, struggled in the new environment. This isn't because his strategy was bad. It's because he tested it in conditions that favored it and then assumed those conditions would continue. He had survivor bias. He was only testing on instruments and timeframes where his strategy type tends to work, not on the full range of conditions he'd actually encounter. Jennifer tested differently. She backtested across multiple years, including both trending and range-bound periods. She specifically looked for the periods where her strategy performed worst and studied why. She tested on different instruments with different volatility characteristics. Her backtest results were more modest because she was testing in a more diverse set of conditions. But when she went live and market conditions shifted, her strategy still worked because she tested its robustness across different environments. There's also a subtle psychological trap here. When you backtest on historical data, you know what happened. Even if you're trying to be objective, your brain knows which signals led to the big winners. You might unconsciously adjust your parameters to capture those big moves. Or you might convince yourself that you would have held through a particular drawdown because you can see that it eventually recovered. This is hindsight bias, the tendency to see past events as more predictable than they actually were. Marcus's backtest included a trade that went against him initially, came back to break even, then eventually hit his target for a big win. In the backtest, he held through this trade. But in live trading, when a similar setup went against him, then came back to break even, he exited in relief. He didn't have the hindsight knowledge that it would eventually become a winner. The psychological experience of uncertainty made him exit at break even, while the backtest assumed he'd hold to target. Professional strategy developers use out-of-sample testing. They backtest on one period, then test on a completely different period they didn't use for development. If the strategy works in both periods, it's more likely to be robust. Most retail traders backtest on all available data, which means they've got no way to know if their strategy will work on data they haven't already seen. Here's what most traders miss. You need to backtest your psychology, not just your strategy. Your strategy might have edge, but if you can't execute it consistently under psychological pressure, that edge is worthless. Jennifer created what she called a psychological backtest. After developing her strategy and running standard backtests, she designed tests for her own behavior. The drawdown test. She paper traded during the worst historical drawdown in her backtest data, tracking her psychological state daily. At what point did she want to quit? At what point did she start doubting the system? She identified her psychological breaking point, 18% drawdown. Now she knows that if she hits 18% drawdown in live trading, her brain will try to convince her to abandon ship, and she can prepare for that. The winning streak test. She paper traded during the best historical period in her backtest data, tracking how her confidence changed. Did she start taking larger positions? Did she start feeling invincible? She identified that after 5 consecutive winners, she began to feel overconfident and wanted to increase her position size. Now she has a rule. After 5 consecutive winners, maintain position size and take a one-day break before the next trade. The signal hesitation test. She tracked which signals she felt confident taking and which ones made her hesitate. She found patterns. Signals that appeared counter to the recent trend made her hesitate, even though those were actually some of her highest probability setups. Now she has a rule. If she feels hesitation, that's a signal to take the trade, not skip it. The time of day test. She discovered she was more impulsive with trades taken in the evening after a full day of work. Her execution quality dropped. She created a rule. No trading after 6 p.m. Marcus did none of this. He tested his strategy against historical price data. He didn't test himself against historical psychological challenges. When he went live, his strategy was prepared. He wasn't. Here's what you need to test that nobody tells you to test. How many consecutive losses can you psychologically handle before you start deviating from your plan? Your backtest shows you might hit 5 or 6 losers in a row. Can you actually keep following the strategy through that, or will you start skipping signals or reducing size? How does your execution change as your account grows or shrinks? Do you get more reckless when you're up? More fearful when you're down? Your backtest assumes consistent execution regardless of account size. That's not how humans work. What's your real maximum drawdown tolerance? Not the number that sounds reasonable, the actual psychological breaking point where you'll abandon the strategy. If your backtest shows 20% max drawdown, but you'll quit at 12%, then your backtest is useless. Which signals do you actually want to take, and which do you have to force yourself to take? If you're forcing yourself to take certain signals, your execution will be poor on those, or you'll skip them entirely under pressure. Jennifer spent as much time backtesting her psychology as she did backtesting her strategy. Marcus spent all his time optimizing his strategy and zero time understanding how his psychology would interact with that strategy. That's why Jennifer is profitable, and Marcus is confused about why his proven backtest strategy isn't working. The confidence trap. Here's something dangerous about a good backtest. It gives you confidence. And confidence in trading can be lethal if it's not matched with psychological preparation. Marcus's backtest was beautiful. 47% annual returns, smooth equity curve, manageable drawdowns. He showed it to friends. He posted about it in trading communities. People were impressed. He was impressed with himself. He went live with real money, feeling like he'd essentially solved trading. This confidence created two problems. First, when the strategy started losing, he couldn't believe it. This strategy is proven. It made 47% annually in the backtest. These losses must be an anomaly. So he kept trading it even as his execution deteriorated and market conditions shifted. His confidence made him ignore warning signs. Second, his confidence made him skip the psychological preparation that would have helped him survive the inevitable rough patches. Why do I need to prepare for a drawdown? My max drawdown in the backtest was only 14%. He didn't prepare because he was confident. Then when a real 14% drawdown happened, he was psychologically destroyed. Jennifer's backtest was good, but not spectacular. She wasn't overconfident. She went into live trading thinking, this strategy seems to have edge. Let's see if I can actually execute it. This mindset, curious, slightly uncertain, prepared for difficulties, was far more psychologically adaptive than Marcus's certainty. There's research in psychology about defensive pessimism. People who anticipate problems and prepare for them tend to perform better than optimists who assume things will go smoothly. In most areas of life, this might make you anxious and unhappy. In trading, it makes you prepared and resilient. Jennifer anticipated that her live results would be worse than her backtest. She built that expectation in. So when her first 3 months were flat instead of up 10% like her backtest projected, she wasn't devastated. She was fine. This is within the range of possibilities I prepared for. Marcus anticipated that his live results would match his backtest. When his first 3 months were down 8% instead of up 12%, he was psychologically shattered. The gap between expectation and reality was so large that he couldn't process it. His confidence evaporated, replaced by confusion and self-doubt. The backtest gave Marcus false certainty. It gave Jennifer useful information with appropriate uncertainty. One mindset leads to psychological resilience. The other leads to psychological collapse. Let me be crystal clear about something. Backtesting is useful. It's necessary, but it only tells you whether your strategy had edge in historical data under the assumption of perfect emotionless execution. It doesn't tell you whether you can actually trade that strategy profitably. The equation for trading success isn't good strategy equals profits. It's good strategy, consistent execution equals profits. If your execution is zero because you can't psychologically handle the strategy's characteristics, then it doesn't matter how good the strategy is. 0 times anything equals 0. Marcus had a good strategy. His backtest proved it had edge. His execution was inconsistent because he wasn't psychologically prepared for what executing that strategy actually felt like. Good strategy times poor execution equals losses. Jennifer had a decent strategy. Her backtest showed it had edge. Her execution was consistent because she prepared herself psychologically for what executing that strategy would feel like. Decent strategy times good execution equals profits. Most traders focus 90% of their effort on optimizing the strategy, finding better parameters, testing different indicators, refining entry and exit rules. They focus 10% or less on whether they can actually execute the strategy. This is completely backward. Once you have a strategy with basic edge, your returns are determined almost entirely by your execution consistency. Here's what professional trading firms understand that retail traders don't. Psychological sustainability is more important than theoretical edge. A strategy that produces 30% annual returns with psychological characteristics you can handle will make you more money than a strategy that produces 50% annual returns with psychological characteristics that will make you abandon it after 3 months. Marcus optimized for backtest performance. Jennifer optimized for psychological sustainability. In the long run, psychological sustainability wins every time. Conclusion: test yourself, not just your strategy. Let's bring this together. Backtesting creates a dangerous illusion that trading is about finding the right strategy. It's not. Trading is about finding a strategy you can actually execute consistently under real psychological pressure with real money at risk. The illusions backtesting creates are that optimized parameters will continue to work. They won't. You've curve fit to noise. That you'll execute perfectly. You won't. Your psychology will interfere. That drawdowns are just numbers. They're not. They're psychological torture. That historical conditions will continue. They won't. Markets change. That confidence from a backtest prepares you for live trading. It doesn't. It might actually make you less prepared. Marcus will probably continue the same pattern. He'll spend months developing and optimizing a new strategy. He'll create a beautiful backtest. He'll go live. He'll fail. He'll blame the strategy or the market and start over. He's trapped in a cycle of thinking that the next strategy will be the one that works, never realizing that strategy development isn't his problem. Psychological preparation is his problem. Jennifer understands that the strategy is just the beginning. The real work is preparing herself to execute that strategy through winning streaks that make her overconfident, losing streaks that make her doubtful, drawdowns that make her want to quit, and market conditions that don't match her backtest period. Your basket can tell you if a strategy has edge. It cannot tell you if you can trade that strategy profitably. Those are completely different questions. Most traders spend all their time answering the first question and zero time answering the second. Then they're shocked when their live results don't match their backtest. My challenge to you: stop optimizing your strategy and start testing your psychology. Take whatever strategy you're currently using and run these tests. Paper trade it through the worst drawdown period in your historical data. Journal your psychological state. Where do you break? Paper. Trade it through the best winning streak in your historical data. Journal your confidence level. When do you start feeling invincible and wanting to increase risk? Track which signals you actually want to take and which ones you have to force yourself to take. The ones you're forcing will be the ones you skip under pressure. Test yourself at different times of day, different days of the week, after wins, after losses, when you're rested, when you're tired. Your execution quality changes based on your state. You need to know when you trade best and when you trade worst. Only after you've tested whether you can actually execute the strategy should you risk real money. A mediocre strategy that you execute consistently will beat an optimal strategy that you abandon after the first drawdown, every single time. Backtesting is useful, but it's testing the wrong thing. Test your psychology. That's what determines whether you make money or not. The market doesn't care about your backtest results. It only cares about what you actually do with real money under real pressure. And what you actually do is determined by your psychology, not by your strategy's historical performance. Stop looking for the perfect strategy. Start building the psychological resilience to execute an imperfect strategy consistently. That's where profits come from.